Hello everyone, welcome. Thank you for joining us. I apologize in advance, my window is open if you hear anything outside. This is going to be another weekly update. I'm going to go through the asset classes, major asset classes that we observe, and we give you our positioning and what we are doing with them, and what we're thinking this week will bring forward. Let's start with Bitcoin. First of all, we are working on a new project. We're rolling this out. We're going to be rolling this out this month, hopefully, till the end. We finish it till the end of this month. It's going to be a Bitcoin trend tracker. We will publish the updates, make the updates available to everybody on a separate site where you can follow them if you want. It just replicates our process. We're sharing it with you, and you can adopt this if you want. We are doing this at a time when BlackRock files for a Bitcoin ETF approval, which signifies that Bitcoin is here to stay as an unique an alternative asset class. Well, it was obvious years ago, but now it's set in stone, so to speak. So, Bitcoin. The last signal that we received on our trend following strategy was on January 2023, 2nd January 2023, right here, after the FTX debacle. We adopted and started following our trend signals ourselves with our money and the money of our clients. If I'm not mistaken, around 6 months ago, but during that time we didn't receive any signal. It was negative on the trend signal, so we've been waiting patiently. We get in just before the FTX debacle. We took a hit on a chin of -7% when this whole thing happened. We avoided the bigger drawdown, so we've took a hit only of 7%. And re-entered when the model turned positive again, and we up 77% since somewhere 70, around 80% since then. And so far the signal continues to be positive. Nothing has changed there. So positive signal. We are in the market when we are in the Bitcoin. From the equity space, we also play Bitcoin, but play it more on the short term. We play MSTR. The name is extremely volatile and of interest. We've highlighted this trade that we took on what was it, a month ago, and it has been very profitable. We are looking to add to this trade if it is possible below $330 if it gets if it gives us an opportunity to do so. But so far, we're just letting this thing play out. Positive for Bitcoin, much less positive for overall crypto universe. Altcoins not doing that great. Ethereum is also underperforming Bitcoin, so we are sticking with the Bitcoin at this moment. And now current very interesting dynamic happened last week. Some signs of a bear steepener we've observed last week. I'm not calling for anything like that. I'm just saying that the correlation that we've been observing in between rate complex and the currency complex and the fiat alternatives complex completely broken, completely reversed, like 180% different. What am I talking about? We've seen a break in the long end in the US and in the whole Europe. We've seen a break in the long end of that magnitude. Let's 10-year and 30-year. This move, we observed this move last week, and in 30-year as well. We're expecting 30-year to reach at some point during the next couple of months to reach 4.5%. But during that move, this is a move of a big magnitude, a relative big magnitude since the beginning of this 2023, where we've been calling for continuous consolidation. Now we're calling for repricing of rates higher at the long end, and it follows the 2-year yield. A 2-year yield is doing the same thing. It's slowly grinding higher in expectation that the Federal Reserve will have to, if inflation will reaccelerate, they will have to step on it once again. And this should have been theoretically, and not theoretically, this studying the correlations as we do, we study rolling correlations, 730, 90 days, 120 days correlations. They should be positive for the dollar. This theoretically, this repricing of rates higher at the long end should have been positive for the dollar, but it couldn't be further from the truth. The last week, dollar broken its trade support, establishing negative lower high on the trending basis, and now this week it's going to retest its net trend support. So at this point, this is the trend resistance, this is the trend support. If it breaks the trend support and unable to hold it, then with the long rates rising as they are, it calls for an interesting dynamics. It does indeed. And if it is unable to hold the trend support, this level, this whole area, this is a tail support. This was essentially the reaction above the tail support. This whole area is a tail support. Once we break the tail support, I believe that Stanley Druckenmiller is right, and we are entering this multi-year underperformance of the dollar. With the rates where they are, it is, and with Federal Reserve probably raising and going, raising rates once again. This is very, I cannot reconcile this with myself. Why? I cannot reconcile the why this will happen, but this is the setup as of now. Negative dollar, short the dollar, short definitely we are negative dollar. We're looking for the ways how to play the short dollar trade. Long euro, long CHF, long pound, long and even JPY. This was an outlier move, to be honest. We did not expect this. We entered the JPY somewhere around 139 and a half, and we've closed most of our position, but we're still holding some of it, some of the JPY. But this was the place, this was not the dollar play. This was essentially the rates play. As the 2-year yield is rising, JPY is weakening. As the rates are repricing in America, repricing higher, 2-year yield, JPY is weakening more and more. But now, since this correlation has clearly broken, and if the dollar breaks its trend support, we're definitely gonna exit all of the dollar long plays. We're definitely gonna exit JPY, and we're definitely gonna exit CNH. As of now, there's nothing to do in JPY. We are holding the position that we have. I don't know. We just have to wait and see this week if the trend that we see in the break in those meaningful correlations are continuing, or it was just one short thing. So across the currency front, short the dollar and be long on a trending basis, and be long of essentially every currency that you can find if the dollar breaks the trend. Long European currencies definitely. And where is the Mexican peso? And long Mexican peso as well. We've been long Mexican peso, and we stay long Mexican peso. Okay, this is the play. Short the dollar play. Next week we're gonna get CPI print, and I believe it's irrelevant whether they disappoint or not. What is relevant is the next month CPI print. If we're going to see re-acceleration in CPI, this is definitely going to be very interesting. Inflation is here to stay, because as Darius Dale from 42 Macro says, soft landing in the economy always equates to soft landing in inflation. And this is essentially what we are seeing right now. Core is staying around 4/6%. It is staying in a consolidation, and headline will stop going down because of the essentially headline popped because of the energy inflation going away. But now oil has been in consolidation for most of the last 6 months, as well as the natural gas. We've essentially headline has priced in all of this move, and now in the rate of change, from the rate of change perspective, there is nothing. It's not going to fall anymore. So we are gonna bounce and float on that level, maybe 3, 4, 5%, maybe even on headline. And I believe this is what the long end is sniffing out, and this is what the long end is doing. Bonds are dropping across all of the curves. Bonds do not like that, and the Federal Reserve and short bonds is the best, especially long end, is the best play that we can get right now. Is because what's the two scenarios? Inflation stays where it is, and bonds reprice to 4.5 anyway, because of the inflation and market recognition of that fact. Or in order to quell that inflation, Federal Reserve raises rates, and let's say they raise rates dramatically. Let's say that they go out. Oh, sorry, I have to close the window. They decide to redouble their efforts, and they go not 25. They surprise everybody with 50 basis points rises in order to destroy the inflation, deliberate disinflation, create deliberate disinflation. If they do so, rates are going up anyway. Rates are going up anyway. So short bonds, and this is the best trade that we've been in, and we continue to hold, and we will add to that trade. So this is the dynamics with the currency, closely related to the rate complex, as well as the fiat alternatives. Another increasingly interesting thing is the fact that incredible move in the long end and rates higher, gold during that period stayed completely indifferent to all of that. If that would have happened in 2022, we would have seen such an repricing of rates higher. We would have seen gold do this stuff. This time, no, it's much more muted. Gold is staying in the consolidation, and overall picture for the gold price is it is just accumulating and consolidating above the tail support. I've been going through the gold chart 10, 15, 20 years back, and I couldn't find such a good setup as I see it right now. We essentially accumulating above the tail support. Dollar is staying and accumulating and getting ready to break the tail support, and gold accumulating, getting ready to explode from the tail support line. This is the tail. Tail is 1800 for the gold price. Everything is in here is a continuous consolidation that we are buying, that we are accumulating and preparing for the move higher. What will happen? What needs to happen for that move higher is either recession. However, it can be caused by endogenous, exogenous event, something outside of the system, something within the system. Recession coming in, they are forced to cut rates. It's positive for the dollar. All of the scenarios that I can envision is positive or neutral for the gold price. So gold is definitely the place to be. Gold and Bitcoin, two assets that protect you from the monetary debasement, monetary inflation. Not from the real inflation, but monetary inflation. Be long Bitcoin. We are long Bitcoin utilizing our proprietary models that we are going to share with you, and we are going long, staying long Bitcoin, gold as a necessary diversifier for any type of the portfolio. Honestly, any type of the portfolio. The only problem with gold that I see right now is, let's say, recession not going to come for the 2 years. 2 years to come. Well, it is a pretty long time to wait and in an asset and allocate capital and use capital to the asset that just stays in place. Let's say it's not going to drop, but it can stay theoretically. It can stay in this bound tight range for, let's say, year and a half, 2 years. You just missing opportunity to allocate your capital elsewhere. What we are doing here is to mitigate this. We are selling puts. Essentially, what we're doing on GLD, we're simply selling puts. Yes, gold is not doesn't have the same volatility attributes that a stock has, where you can go for 19 delta, 30 delta, and just capture that volatility and sell on the moves down. Yes, and ride the move lower in the volatility afterwards, because it's incredibly low vol asset, 13 realized and 14 implied volatility at this point. but it is still better. Now we are just selling month over month. We are doing the ladder, so to speak, selling 2 weeks and 1 month continuously. Week after week, we're selling puts, selling. If we're getting filled, we're completely fine with that. If we're not getting filled, we are generating income in that manner. And income, even with that realized implied volatility income that we are generating is what is it? We're deploying, let's say, 1 month put, 30 delta put, or 19 delta put. It's going to cost you $80 right now, and you can tie up what it requires you 400 bucks. So the relative profit is very nice. It's essentially not bad. It is not bad. It's one of the ways to generate income on the asset that just doesn't give you any income, right? This is the gold price. This is gold price, and the silver, same thing for the silver. If you're ready to commit your capital to the silver, it is a good place to do this. I would not wait for the break-in trend. It is positive tail. It is, as well as the gold, it's positive tail, and we will be long silver, and we would be long gold from here. A good place to be long for the long haul for the next couple of years for the tail. Nothing to highlight in commodity space. We've talked about rates, and another thing to highlight is the European rates. Give me that. Multi-year, not year, maybe a year consolidation, and we are coming out of this consolidation, breaking through higher. I would expect repricing in European rates higher once again. This is negative for high yield, especially it is negative for high yield. We've been short high yield for a long time now, but compared to the 2022, the high yield short hasn't been as profitable as we can see because of the rates has been in consolidation. I can plot the 10-year on the high yield chart, and we see that the correlation are minus 80%. Rates has been in consolidation, and high yield has been in consolidation. But now with rates repricing higher, high yield is incredibly sensitive to repricing of rates higher. It's not like SPY. It much more. The correlation, I believe, right now is minus 80 to 82% on the 90-day realized volatility. So the higher the rates go, the lower the high yield goes, and we received negative signal. One of the best negative signals that you can receive: a negative trend, negative sale, negative trade at the moment, and we've retested the trend resistance, swept it, couldn't break above it, and went lower. So I would definitely expect high yield to reach 72, and depending on how high the rates will go, we may even see 70s on the high yield. But stay short high yield if you are interested in that kind of thing. So this is another thing that points to the negativity for the SPY, for the equity indices overall, and negative high yield, negative credit, short credit, and SPY. The thing with SPY is it's much less sensitive to the repricing of rates as we've seen throughout the 2022. We might see the repeat of 2022 if they go again, if they step on it and raise rates by 50 basis points again, they continue to raising rates to quell inflation. This will be definitely negative for the SPY. If not, we are not bullish on SPY at this point, not at these prices, not here. And moreover, if rates will continue rising and TLT will continue falling as it is, we've seen what happens with SPY. SPY drops when the TLT reprices lower with that magnitude. SPY cannot hold its own at that time. Same thing with rates in Europe. When the rates in Europe reprice with such velocity higher, no indices in Europe can hold the ground. We are seeing these moves. We are seeing meaningful repricing of things lower across the curve. So we do expect repricing of rates higher, and we do expect indices to underperform. It's not the best place to be short. The best place to be short is the bonds itself, but we cannot be positive on SPY at this point. So it's either chop or a retracement. Trend level for SPY is 431. Whether it breaks it or not, we shall see. But we've been bullish since this consolidation. We've been bullish, but right now, with the overall macro picture, with what the rates are doing, very hard to be long SPY at this point. Honestly, very hard. So we're holding all of the longs that we want to hold for the long haul. We're not reducing them. We add into them. And we employ some of the income generating strategies that we like, and continue holding them, such as ASVOL, HFND, and HFND. Some of those. And that's it. There's nothing to be from the indices perspective. There's nothing to be long right now in America. I don't see that. Other things that we like, if we want to play short dollar trade, is EWW, is Mexico. Mexico ETF, bullish trend, bullish trade, and the trend level for is $61 for this ETF. So we're accumulating EWW. If we're correct in the short dollar trade, this thing should go up as well. We've been contemplating the possibility of going long the European stocks, but once again, with the move in rates, this has completely reversed. China remains, irrelevant. I don't see, from our perspective, there is no signal on China. We would like to short it, but this move once again in rates, this breaking correlation in between rates and the dollar, completely reversed the game. We have to see how the model will react during the next week and maybe the week after, in order to place our bets once again, because the break in between the positive correlation between dollar and rates is very significant. And our expectation has been that the more rates rise, the more the dollar will rise, and the less positive the outlook will be for China as well, for CNH and for the China. But this break in the dollar changes everything. So we have to wait and see. Dollar will define everything, essentially. This break in trend for the dollar, will have to give it more time. But if it breaks 102, I think it's safe to say that we might see the next 3 months, 4 months, 5 months as very negative for the dollar. Why that would happen? Honestly, fundamentally, I get the bigger picture, the short thesis on the dollar, but I don't get why that would happen with the rates still rising and them still raising rates. So this is the update. A lot of uncertainty. We're not planning to take on big risks, especially the upcoming week. We're playing it very safe, trying to save and preserve the capital that we've already made since this year. The one thing that we are dabbling on is the short TLT trade. Any bounce. We are getting the CPI report on Wednesday. If it comes in lower than expected and yields bounce back, the higher they go, the better the opportunity to sell. The higher they bounce, the better the opportunity to sell. So this is the trade that we are staying with.